step into the world of capital markets for just a moment. I mean, think about the sheer speed, the complexity,
Hmm.
the trillions moving globally every single second. It's where fortunes are made, yes, but also, unfortunately, where illicit money finds some incredibly clever ways to hide right in plain sight sometimes.
That's right. It's a
Yeah.
perfect environment for it in some ways.
So today we're taking a deep dive into exactly that hidden world. Money laundering within capital markets. It's a dense, high-stakes area.
Definitely.
And figuring it out means understanding the intricate methods criminals use and also what financial institutions and regulators are doing to try and stop them.
A constant battle, really.
Our insights for this deep dive come from an article from FinCrime Intelligence, which really pulls back the curtain on this specific challenge.
A very good resource on this topic.
So our mission here is to unpack these sophisticated ways illicit money moves through securities, through investments, understand what the experts are looking for, and frankly, why it's so challenging to stop.
Yeah.
We're really focusing on the how and the why of financial crime in this specific context, using the article as our guide.
Makes sense.
Okay, let's unpack this. So first things first. When we talk about money laundering in capital markets, what exactly are we talking about? How is it different? How does someone even begin to do it there?
Well, according to the article, the core idea is disguising illegal money, right? Its
Mhm.
origins, but doing it within the securities and investment industry.
Okay.
So it's about using the market structure itself, the buying, the selling, the instruments, to make dirty money look like it came from legitimate investment activity.
Right, cleaning it through trading.
Exactly.
Yeah.
And what's really crucial to understand is why capital markets are so, well, attractive for this and different from, say, just walking into a bank.
Mm-hmm.
You've got incredibly complex financial instruments readily available, the derivatives, structured products, things that aren't straightforward.
Not your average savings account.
Definitely not. Plus, transactions are often very high value, they frequently cross borders, and maybe most importantly, the structures used to hold and move these assets. They're often deliberately layered.
Layered how?
Layered to obscure who really owns the money, where it really came from, hiding the beneficial owner, hiding the source.
Right, so it's not like depositing a suitcase of cash. It's using the system's own tools against itself.
Precisely. Leveraging the complexity.
So how do criminals actually do that? What are the common tactics the article mentions?
Well, they use a whole range of methods to create distance, from the illegal source. One key way is simply buying and then quickly selling securities.
Just trading.
Yeah, but maybe repeatedly.
Yeah.
Turning it. By doing this, they can make the original illicit funds look like they're just profits from successful trading when they eventually cash out.
Yeah, okay. Creating a paper trail.
A plausible paper trail, yes. And layering transactions is absolutely fundamental. This often means moving funds across different jurisdictions, different asset classes, like buying stocks in, say, London, then maybe using those proceeds to buy a bond through an entity in the Cayman Islands, moving through various exchanges, various firms. Each step adds a layer.
Making it harder and harder to trace back.
Incredibly difficult for investigators, yes, especially tracing it back to the original crime.
And you mentioned hiding who's behind it. That
Ah.
seems key.
Oh, absolutely. The article really emphasizes the use of shell companies or nominee accounts.
Okay, define those quickly.
Sure. Shell companies are basically corporations that exist only on paper, no real operations, no offices. Nominee accounts are where someone holds assets in their name, but really on behalf of someone else. Both are used specifically to hide the beneficial owner.
The real person pulling the strings.
Yeah. Exactly. The one who ultimately owns or controls the money, not just the name on the paperwork. These are set up purely for disguise, often.
Got it. Any other techniques?
Yes, another quite sophisticated one involves circular trades or wash trades.
Wash trades, I've heard that term.
Right. It's where someone might buy and sell the same asset pretty much simultaneously, maybe to themselves, through different accounts, or between related parties.
Oh, why? What's the point?
Well, it doesn't usually have a real economic purpose. The goal is often to artificially inflate the trading volume for that asset, or maybe distort its perceived value.
And that helps launder money how?
It makes it look like there's legitimate, active trading happening. It can disguise the movement of funds between related parties or just create noise and complexity that helps hide the illicit flows within seemingly normal market activity.
Clever. And complex.
Very. And they also exploit vulnerabilities in the system. particularly lightly regulated intermediaries.
Like who?
Maybe certain types of brokers, custodians, or offshore affiliates that perhaps don't have the exact same level of strict AML checks as a huge global bank might.
Finding the weaker links.
Essentially, yes.
Yeah.
And the article points out a really core challenge through all of this, the sheer speed and scale of capital markets.
Yeah, we mentioned that at the start.
Laundering can happen incredibly quickly, mixed in with trillions of dollars of legitimate activity. Without really sophisticated monitoring, it can just vanish into the noise.
That speed does make detection sound almost impossible sometimes. So let's get more specific. You mentioned methods, but what about the actual transaction patterns? The article calls them typologies, right? These common schemes.
Exactly. Typologies are like the known recipes criminals use. The article lists several key ones specific to this capital markets environment. Wash trading, like we just discussed, is a prime example.
Buying and selling to yourself to create fake volume.
Right, inflating volume, obscuring where funds are really moving. Related to that are matched orders.
How's that different?
It's similar, but involves coordinated trading between two or more parties. They agree beforehand on the price, the volume, the timing.
So it looks like a normal trade on the surface.
Yes, but it's not driven by genuine market forces. It's a prearranged way for, say, two criminal groups or related entities to move money or securities between them discreetly, disguised as normal trading.
Sneaky. What else?
Pump and dump schemes are also mentioned. Now, we often think of these just as market manipulation to make a quick buck.
Right, hyping a stock, then selling it off.
Exactly. But the article notes they can also be used specifically to layer funds. Criminals manipulate the price way up, sell their holdings for a massive gain, and suddenly their illicit funds look like legitimate profits from smart trading. The manipulation itself helps the laundering.
Wow, so the market abuse and the laundering are actually intertwined in that case.
Precisely, they serve both purposes. Another typology is using low liquidity instruments.
Meaning stocks or bonds that aren't traded very often.
Exactly, or things traded over the counter, OTC, not on a major exchange. Trading these can help launderers avoid scrutiny because there's less public data, less price transparency.
With more ambiguity.
Right, ambiguity they can exploit. It's easier to potentially manipulate prices or justify unusual transactions when things are already a bit murky.
Okay, that makes sense. Keep going.
Layered settlement chains are another one. This means using multiple intermediaries, brokers, custodians, sub-custodians, maybe across different countries, just to hold and transfer the assets.
So it's purely about adding steps.
Purely about creating layers of ownership and control. Each step makes it harder to see who the ultimate beneficial owner is and where the assets originated.
Just making the trail longer and more confusing.
Exactly. And finally, just rapid in and out trading itself is highlighted as a potential red flag typology.
Like day trading.
Well, yes, but maybe high-frequency buying and selling with no clear investment strategy, especially if it's happening across different jurisdictions or exchanges constantly. It might look like excessive churning, but it could actually be a method to move value very quickly and create this tangled web that's incredibly hard to unravel later.
Okay, so those are the actions, the schemes. But amidst all this high-speed trading, how does anyone even spot it? What are the signs that something's wrong, the red flags the article talks about?
Good question. The article lists several key indicators that compliance teams and their surveillance systems are specifically trained or programmed to look for.
Like warning signals.
Exactly. A big one is unexplained or disproportionate trading activity coming from accounts that are usually small or inactive. Why is a dormant account suddenly doing massive trades?
Yeah, that would stick out.
Another is frequent trading in those illiquid securities we mentioned, especially if there's no obvious investment strategy behind it. Why are they constantly trading this obscure bond?
Connects back to that typology. Makes sense.
Then there are securities transfers. If assets are moving between parties or across borders where there's no obvious business link, no personal connection, that's highly suspicious.
Why is Company A in Panama sending shares to unrelated Company B in Cyprus?
Exactly. No clear reason. Obviously, trading patterns that clearly mirror those known typologies, like the system flagging what looks like a wash trade or a clear layering pattern, those are immediate red flags.
The system catches the pattern itself.
Hopefully, yes. And finally, a big one is customers using opaque structures without a good reason. Things like omnibus accounts.
Where multiple clients' assets are pooled.
Yes, or nominee accounts, or complex offshore vehicles. If the client doesn't have a clear, legitimate business need for that level of complexity and secrecy, It's a major indicator they might be trying to hide something.
Probably their identity or the source of the money.
Most likely, yes. So these red flags are sort of the surface signals, the clues that can point towards those underlying typologies being used. They're what firms are watching for to trigger a closer look.
It sounds like institutions need a whole arsenal of tools and really vigilant processes to catch this stuff. So, what is the regulatory response? What are bodies like, say, the FCA in the UK or the SEC in the US telling firms they absolutely have to do?
Well, regulators worldwide, including the ones you mentioned, plus others like ESMA in Europe,
Hmm.
and global standard setters like FATF, the Financial Action Task Force, they have pretty strong and constantly evolving expectations.
They have to keep up.
They try. They require firms to implement robust controls covering both anti-money laundering, AML, and market abuse, and importantly, controls that are specifically tailored for the unique risks of capital markets operations.
Not just generic bank rules.
No, it has to fit the context. So this includes foundational things like customer due diligence, or CDD basically, verifying who your client is.
Know your customer.
Right. And enhanced due diligence, EDD, for clients deemed higher risk, maybe because of their location, their type of business, or if they're politically exposed persons.
Okay, standard stuff. But what about the trading itself?
That's where it gets specific. They expect know your trading processes, or
Oh.
KYT. This goes beyond just knowing the client's name. It means understanding their expected trading patterns.
What they normally trade? How much? Why?
Exactly. What instruments do they typically use? Is there a documented, legitimate economic rationale for the trading activity they're conducting? You need to understand the why.
That sounds intensive.
It is. And there's a huge emphasis on having sophisticated transaction and trade surveillance systems. These aren't just simple alert systems anymore.
What do they need to do?
They need to be capable of detecting not only market abuse, like insider trading or manipulation, but also suspicious behavior that could indicate money laundering. And as we've discussed, those two can be deeply intertwined.
Seeing both sides of the coin.
Yes. And if something suspicious is detected by these systems or by staff, there are mandatory reporting obligations.
Telling the authorities.
Right. In Europe, it's often called suspicious transaction and order reporting, or STORE. In the US, you have suspicious activity reports, SARs. These are specifically for activity that seems to lack economic sense or suggests manipulation because, again, that's often the cover.
Got it. What else?
Firms are also expected to conduct periodic risk assessments. And the article stresses these shouldn't be just high-level box-ticking exercises.
They need to be detailed.
Very granular, tailored to specific trading desks, different asset classes, different ways clients access the market like direct market access, DMA, or algorithmic trading, which have their own risks.
What's really fascinating here, though, according to the article,
Hold on.
is that regulators increasingly expect firms to demonstrate active oversight. It's not enough to just have the systems.
Proving it works.
Exactly. You need clear, documented policies. You need audit trails showing why you investigated something or why you didn't. You need strong governance frameworks showing someone is actually in charge and accountable.
It's about embedding it in the culture, not just having a tool.
Right. It's not just buying software. It's showing you're actively using it, tuning it, managing the risks it flagged.
That layered, proactive approach makes total sense.
Yeah.
But it also sounds incredibly complex to actually implement,
Yeah.
especially given the scale and speed we talked about.
Yeah, that's what I was thinking. What are the main hurdles, the big challenges institutions face in putting these controls into practice effectively?
The article lays out several really significant challenges. First, just the sheer volume of transactions and market data generated every second is immense.
The data deluge.
Absolutely. Processing and analyzing all of that accurately in near real time.
Mm-hmm.
It requires incredibly powerful surveillance tech. And even then, you get a ton of false positives.
Alerts on legitimate trade.
Exactly. Which then need investigating. And that drains a huge amount of analyst time and resources. Sorting the signal from the noise is a massive task.
I can imagine. What else?
Well, the global nature of trading adds layers of complexity. Funds and securities are constantly flowing across borders through different legal systems, different regulatory regimes.
Hard to get a single view.
Very hard to get a complete global picture of a client's activity or a transaction's full path. Then there's the speed again, the short holding periods, especially in high-frequency or algorithmic trading.
Things move too fast.
It makes tracing the source of funds after the fact incredibly difficult. By the time a surveillance system flags a potentially suspicious pattern, the money might have already moved through several more accounts or instruments. The trail goes cold quickly. The use of intermediaries also complicates things. Prime brokers, serving hedge funds, clearing firms, investment
They
advisors.
just sit in the middle.
Right.
Hmm.
Institutions rely on them, but they can also add layers of opacity, making it harder to see the underlying client or the ultimate activity sometimes.
Another layer to peel back.
And a major challenge the article highlights is the limited transparency into beneficial ownership, especially when you have complex legal structures involved, like special purpose vehicles, SPVs, trusts, particularly offshore ones.
Back to the shell companies issue.
Exactly. It's inherently difficult to know who is truly behind a trade or an account when there are multiple layers of legal entities deliberately set up to obscure that fact.
So, facing all these difficulties, the volume, the speed, the complexity, the opacity, how are institutions trying to tackle them? You mentioned technology earlier. Is that the main answer?
Yes, the article definitely pointing towards technology as a key part of the solution, or at least the attempt at one. Institutions are increasingly turning to more advanced tech to try and keep pace.
Like what specifically?
Things like AI-based analytics and behavioral modeling, these go beyond simple preset rules. They try to learn normal patterns of behavior for a client or a market, and then spot unusual deviations that might indicate risk, even if it doesn't trigger an old-style rule.
More intelligent detection.
That's the goal.
Hmm.
They're also implementing more integrated market surveillance platforms. The idea here is to combine that traditional AML data, like customer risk scores, transaction history, with the market abuse data from trade surveillance.
Bringing it all together.
Right. Trying to get a more holistic, risk-based view across all the client's activity,
Mhm.
rather than having AML looking here and market abuse looking there, potentially missing the connections.
That integration seems absolutely critical, given how linked these things can be. Okay, so finally wrapping this up. Based on the article, what really constitutes an effective AML program in this specific complex space? What are the key best practices institutions should really focus on?
The article emphasizes a few key things for an effective program. First, and maybe most importantly, is having a truly tailored, risk-based approach,
Meaning,
meaning you actively consider the specific risks presented by the products being traded. Some are way more complex than others. The type of client and individual is different from a hedge fund, and the way they access the market. You can't have a one-size-fits-all approach. It just won't work here.
needs to be customized.
Deeply customized. Second, integrating that AML and market abuse surveillance across all the desks, all products, all regions is highlighted as crucial.
We just touched on that.
Yes, because these areas are so often linked. Spotting manipulation might help uncover laundering, and spotting suspicious money flows might help uncover manipulation. You need the full picture.
Makes sense. What else?
Using machine learning and those advanced analytics tools is seen as pretty vital now, not just to detect the complex patterns criminals use, but also, critically, to help reduce that huge burden of false positives, allowing analysts to focus on the real risks,
Making the tech work smarter.
hopefully. Then there's the human element. Regular, specific training for staff is absolutely vital.
Not just compliance people.
No, definitely not. This includes front office staff, the traders themselves, operations teams. They need to understand the latest typologies, the red flags specific to their area, and crucially, their reporting obligations. They're often the first line of defense, seeing things the systems might miss.
Eyes and ears on the ground.
Exactly. And fostering strong internal collaboration is key. Getting different departments, AML, compliance, ops, trading teams, even IT, talking to each other, sharing insights, sharing intelligence, and having clear paths to quickly investigate and escalate concerns. Breaking down silos.
Collaboration is key.
Very much so. The article also notes the importance of engaging outwards, participating in industry initiatives, talking to peers, consulting with regulators to stay ahead of, or at least aligned with, evolving threats and supervisory expectations. It's a constantly shifting landscape.
An arms race, as you said earlier.
Pretty much. And, if we connect this all back to the bigger picture, the article's conclusion is quite clear. Capital markets are inherently attractive to illicit activity precisely because of their sophistication, their speed, their global reach.
The very things that make them work.
Exactly. So effectively combating this requires continuous investment in advanced tools, yes, but also strong collaboration within firms and ongoing engagement with the wider industry and regulators. A proactive, intelligence-led, risk-aware approach.
Right.
It isn't just about ticking compliance boxes anymore. It's really fundamental to upholding the basic integrity and trustworthiness of the global financial markets we all rely on.
This has been a really fascinating deep dive. We've unpacked a lot here, what money laundering actually looks like in the unique context of capital markets, the sophisticated methods used, the significant challenges in spotting it,
Hmm.
and the layers of defense that regulators and firms are trying constantly to build and reinforce, all drawn from those insights in the FinCrime intelligence article.
It's a complex picture.
It really is. And understanding this, it isn't just for people working directly in finance. If you're an investor, maybe someone working in a related field, or honestly just someone who wants to understand how the global financial system works and where its vulnerabilities are.
Yeah.
Grasping the sophistication of these crimes and the sheer challenge of combating them is absolutely key to being well informed about the financial world you interact with, even indirectly.
Absolutely. And, this raises a really important question, I think.
Hello.
Given everything we've discussed, the speed, the scale, the complexity, this constant cat and mouse game between the criminals and the compliance efforts,
Yeah.
how much of this sophisticated laundering activity might still be occurring successfully under the radar?
Hmm.
And what does the possibility of that undetected activity really mean for the overall integrity, the trustworthiness of the very markets you might participate in, perhaps even just through a simple retirement account? It's something worth thinking about.